Everybody in your audience believes that 7 years from now, their way of life will be essentially unchanged. And if that is true, that means that everybody believes that commodity prices are going higher. When you go to the garage, turn your car key to the right. If you believe that the engine is going to start and the car is going to run, you believe that oil prices are going higher, because at today's oil prices, there won't be any gasoline in 7 years. If you believe that you'll have a new car in your garage 7 years from now, that means that you believe base metals prices are going higher. I believe that a credit disruption is here in the mining industry. 2 credit disruptions, in fact. The senior project banks that used to provide project for non-investment grade mining companies have left the business as a consequence of Basel III. What that means is that about $5 billion a year in project debt has to be financed by non-traditional lenders. That's very disruptive. The second disruption is the junk debt market, of course. Junk debt markets in all industries, but particularly mining, has been roiled. And my suspicion is that the very low oil prices that we have seen will cause further disruption in the junk bond markets in the third quarter of this year, and that disruption will last at least 18 months. So yes, the markets are disrupted, and yes, they will become more disrupted. 2 lessons. The first is that people matter most. The truth is that mines are often made rather than found. And if you do business with very good people, you will be substantially more successful than if you're less choosy with regards to people. The second thing is, and we've really learned this at Sprott in the last 5 years, pay attention to your downside. Your upside will take care of itself. In the mining business for the last 5 years, as lenders, we've enjoyed 20% compound internal rates of return on our mining portfolio. No equity portfolio in the mining business in the world has done anywhere near as well in the last 5 years. If you pay attention to return of capital, the gains will take care of themselves. Just shelter yourself from the loss. That's very important for your listeners to understand. Your expectation of the future is set by your experience in the immediate past. And in the mining business, everybody's experience in the immediate past has been lousy. If, as an example, the gold price were to decline from today's, $12.80 down to $11.50, many people would be shaken out of the gold market as a consequence of their experience in the last 5 years. They'd think that this was a head fake. I remember all the way back to 1975, the gold price had run from $35 to $200. It declined from 200 to 100. People got shaken out in that decline, and they missed a move from $100 to $850 in 5 short years. The expectations following a bear market are the continuation of a bear market. If you get shaken out by a cyclical decline in a secular bull market, you are making one of the big mistakes of your investing career.